Joining us right now, Fieldpoint Chief Investment Officer Bill Kennedy and PNC Wealth Management Chief Investment Strategist Bill Stone. Gentlemen, good to see you.
Good morning.
Thanks so much for joining us. First, let's talk about the Bank of Japan. Important? How'd you see it?
I think from a policy standpoint, it's bad policy. You're trying to apply a cyclical solution to a structural problem, which is the debt overhang. It really is compounding the currency wars effect that is in place. I'm very concerned what the BOJ move, what the response will be from the Chinese. But most of all, I think it means continuation of the strong dollar. And a strong dollar means weak oil. Weak oil, because of the correlation with the stock market, means that stocks are going to be under pressure.
Yeah, so Dagan, no real impact to the fundamental story of the Japanese economy, more monetary policy stimulus.
Right, and if you get, again, we had comments from Mario Draghi, right, and you had a major bounce back in global stock markets.
That was the speech on Monday.
Right, this is a fugazi market. It is fake, it's ephemeral, it's the bibbity-bobbity-boo market, because none of this, there's nothing substantial here. There's nothing real. We get excited about them encouraging people to take more risk while the risk is blowing up in our face.
And yet, look at the market, 3%, Jack Otter. Stocks rallied on this.
Well, for years, it was the Greenspan put, then the Bernanke put, then the Yellen put, and finally maybe the Fed was saying, okay, we're going to end that. The market tanks. And now you've got the Draghi put and the Bank of Japan put. And it is worrisome because like Dagan's saying, it's not real economic growth, but nowhere in the globe do we see real economic growth.
And we should point out that bank stocks in Japan were actually negative. They were down, but the rest of the market rallied on it, Bill Stone.
I mean, I'm going to get a little more positive on it. You know, by the way, Japan has a lot of problems, so I'm not saying that. But what I will say is, at least they're trying to break that cycle of deflation. I get it. This may not do it, but if you're going to do it, you have to be consistent and just do everything you can, because I think part of what has haunted Japan for all these years has been they've done kind of part way and then stopped, and then things have slid right back.
So you would buy Japan?
We're overweight Japan, so we like. You know, we like today.
I like bibbity-bobbity-boo.
Well, no, I think you have to separate Japanese companies from their economy, because Japanese companies do a lot of business outside of Japan.
They're doing well, the companies.
Yeah, and the companies are earning more money, and it's real money, so it matters.
And importantly, they are finally breaking out of some of these lousy practices where, you know, I own your stock, you own my stock, and we give each other sweetheart deals. We're seeing that finally improve.
Right.
That's absolutely the biggest deal for me. So I watched that they're raising their dividends. They now care more about the shareholders. They didn't used to, you know, frankly, care what the shareholders thought about anything, I think. So now you're seeing return of capital shareholders. As a shareholder, that's what I'm interested in.
I'm glad you mentioned that, because that's true. The earnings are there. I want to talk about earnings in the U.S. for a second, because the Dow Jones Industrial Average year-to-date 2016 down 8%, 7.7% on the Dow. NASDAQ's done even worse year-to-date, down 10%, correction mode for the NASDAQ. And then there's Amazon. What's your take on the earnings?
So I think overall, earnings expectations have been coming down. The consensus right now is for about 10 to 12% earnings growth in 2016.
That's not bad.
You need 3% GDP growth to achieve that. So
that's a high expectation.
Very high expectation. So we think right now it's going to be closer to 8%, but that assumes that the dollar stays flat or weakens. If the dollar appreciates another 5% from here, we're going to have flat earnings for the S&P in 2016, and the market has not discounted that as of yet.
Sounds like you want to sell into this.
We would be definitely selling any of the rallies here.
I'm worried about financials. Hello, it's the second worst performing sector in the S&P.
Down 15% earlier.
Only down 11.5% so far this year. How is that not sending a negative signal about the overall economy?
And it's a great point. If you look at the yield curve, the spread between the 2-year, 10-year has flattened ever since the Fed raised rates back in December. We're at 115 spread right now. We think that's a very trouble signal in the market.
I mean, I also say with the financials is they were acting better when people thought maybe not that the Fed was going to raise rates 4 times this year, even though the Fed said that. You know, I think most of us thought maybe more like 3. Now the market's saying more like 1. There's also that overhang, at least with some of them, on worries about loans to energy companies, right? I mean, that's at least part of it. I honestly don't believe that's a huge part of it, because I think that's pretty contained, and
especially for the big banks. Not
exactly. Yeah, I don't think it's an
small share of their loan book.
Exactly.
It is. I don't think it's an issue.
It's still a negative story.
Yeah, it is.
And these knock-on effects of oil have come forward this year, but
who's holding on to that debt? If it's not the banks, it must be the shadow banking system or somebody else. Could be the sovereign wealth funds. We've thought much of what we've seen in January is a liquidity crunch. We're seeing U.S. assets being sold. We think a lot of that is capital being repatriated to some of the big oil exporters who have large sovereign wealth funds. And we think that's really been the key driver of this downdraft in the market.
I'm glad you mentioned this, because I actually retweeted something from Barron's yesterday. You guys reported that Saudi Arabia in particular were selling stocks and bonds to sovereign wealth fund. Is that why this market has been so weak in 2016? It's the sovereign wealth funds that have been dumping U.S. equities.
Well, you know, the old joke is, why did the market go down yesterday? There were more sellers than buyers. Well, clearly there's a really big seller with a whole lot of money, and that selling pressure is not going anywhere. Saudi Arabia is going to continue to need to unload assets to try to shore up their balance sheet. So this is yet another interesting, you know, knock-on effect of the falling price of energy prices.
Right.
One thing I will say about banks, though, you know, while it is a negative indicator, I'm not jumping in right now. At some point, the contrarian has to start getting a little bit excited.
Because the valuations.
Yeah, the valuations, the balance sheets are in fantastic shape versus, I don't know how far back you have to go to see this kind of capital on the books. So at some point in single-digit earnings, good return on equity, these things are going to be a buy.
Real quick, I know you're a seller of this market, Bill. Are you a buyer?
Yeah, I am. We like it. I mean, I think you've gotten that sell-off. I think, again, you got to stay longer-term thinking, but I think people have gotten so negative that it's worth being on the other side of that.
Great to have you both on the show.
Thank you.
Thanks so much. Bill Kennedy, Bill Stone joining us there.